Hi, good afternoon, everybody. I've got a presentation, and I think I'm speaking for 25 minutes, and then some time for Q&A. And I do have a lot of ground to cover, because I want to talk to you about a couple of things. The first is, you guys on the last presentation were talking about black swans, but we did have a black swan event this year. And I think many of you might have actually also made some decisions that you regret because you might have rage sold at the bottom. So I want to explain to you why, one, you probably weren't alone in what you did, although our clients, we advise them not to do anything. But second, because of where the market is, I actually think there's opportunities. And so I'll talk about why, if you're reluctant to buy now, you shouldn't be reluctant. So hopefully that's going to give you some optimism. So before I start, I just want to explain a little bit about my company, because we have some folks here from Fundstrat. Yes, if you guys can just stand up. That's Mark Newton, who's speaking at 1 o'clock. He's our head of technical strategy, and the guy I use for all the tactical calls. And then there's Jill and Alexa, who are on our communications team, and we have a booth over there. But if you're a self-directed investor, we have FS Insight if you're interested in following markets. But if you want to just let us make the investment decisions for you, we have an ETF called Granny Shots, ticker GRNY. And they asked me to put this QR code if you want a free trial to the service. But I'll put it up at the end. Okay, so April 2nd was a Black Swan event. And it's not the Black Swan movie premiere, but it was an improbable event, as Nassim Taleb talked about. And a Black Swan means something that is not expected to happen, but it has happened. And we know it was a Black Swan event because Nassim Taleb's Universa fund generated 100% return that month. His fund only makes money on Black Swan events, and the last time it made money was COVID. So this was indeed a Black Swan event. And because of that, the S&P went from 6,147 and collapsed because we had the drug tariffs in February, and then we had the DeepSeek event, and of course, Tariff Liberation Day. That triggered a huge amount of panic. And as you can see, we fell 20% in like 2 weeks. But instead of the market crashing, we had advised our clients that waterfall declines, 17 out of the last 18 waterfall declines were V-shaped. A waterfall decline in the stock market is not new information to you, it's a panic. When markets panic, just keep this in mind, it's usually a V-shaped bounce. And we argued it would be V-shaped, and in fact it has been V-shaped, contrary to what most people have said. Now, this is where I'd like you guys to make a personal assessment, because you aren't alone. A lot of people, when the market was falling, hedge funds, long-only managers, they went to cash. I've done so many Zooms in the past 2 weeks about fund managers that have probably 50% of the exposure they want to cyclical stocks, or even 0%. So they are panicked and they're hoping for a pullback so that they can re-risk. So here's 5 reasons why I think investors are still off sides, and that's why you've noticed that the stock market kind of has a bid every day, because people are still off sides. So let me explain. The first is, a lot of people said there was going to be a recession. And in fact, JP Morgan was one of the first. They said they raised the odds of a recession to 60%. But here's the thing. If you want to know who's the best at predicting a recession, I would say the single best economist is the high yield market. And this is the high yield market. And as you can see, it did soar. This is the spread to treasuries, to 460 basis points wide. But that's not a recession panic. The high yield market is not manipulated by the Fed or the Treasury, so it's pure signal. If you go back the last 15 years, 460 basis points wide on high yield is nothing, because during COVID it got to 1,000. That's a recession level. During the Fed's fastest rate cycle in history, it got to 600. That's not a recession signal. At that time, if many of you were our clients, we told you that's not a recession signal. It has to get to 800 or 1,000. And we were just at 460. So the high yield market said there's no recession. And then, as you know, recently JP Morgan basically dropped their recession call. So economists have predicted like 18 of the last 2 recessions. The supply chain is taking a hit. And then a lot of people are saying they're shorting stocks because of that, okay? And you might think that. You're going to say, Tom, the container ships from China, it's down 50%. So they're going to say, okay, it goes from the container ships to the trucking, to the warehouses, to the retail stores, and pretty soon everything's going to crash. But that's not how it's going to work. First of all, as you can see, as soon as the tariff wars de-escalated, container ship bookings jumped 50%. So it now looks like this. The stock market looks through that. That happens with government shutdowns. It doesn't really cripple the economy. Yet hedge funds were shorting cyclicals this entire time. So again, your people are looking at yesterday's newspaper and trading on it. The third is the VIX surged, but when the VIX surges, it forces everybody to liquidate. Okay, so the top chart here is the VIX, and the bottom is speculative longs on futures. Every time the VIX spikes, funds are forced to de-risk. Okay, but look what happens after the VIX goes down. They're forced to add risk. So here's the thing. In the midst of the VIX 60, our FSI clients got this message. You buy stocks when the VIX is over 50, and it's confirmed when the VIX is less than 30. Just remember that. The next time the VIX explodes to 60, it's a gift because you know everyone's being forced to sell. And the bottom in the stock market, we highlighted this, there's not been a single bottom that wasn't confirmed once the VIX falls below 30. So if you look back, that VIX 30 was like mid-April. The fourth is, many people say the U.S. is the end of U.S. exceptionalism, like they want to buy Europe. I just had a call with this client. He's so bullish on Germany, and I pointed out to him that German tech stocks are now 50% more expensive than U.S. tech stocks. Europe is not cheap, and they don't have great companies. In fact, if you look at the 25 biggest companies in the world, it's kind of hard to see the ticker. Only 4 of them are not American. I don't see how tariffs, a Fed being slow, people not liking Trump, I don't think how that's going to create 24 great non-US companies. All the best companies are in America. And then retail bought the dip. So if you are one of the few who bought the dip in April, congratulations, because you called it right and you nailed it. And we know retail buying was record during the sell-off. And I can't tell you how many institutions told us that they were shorting that because they want to short retail. They're dead wrong. Retail investors got this right. And yet, now what's happening? Hedge funds are frantically covering their shorts. It's going to take them a long time to cover their shorts. Okay, so now I want to look at 2026. So it's explaining where things are, and I will say, so if you are bearish still, I would urge you to think about 2026, okay? I think stocks are in better shape today than they were in February of this year. So when the market was at its old highs, I think it's actually a better risk reward now. First, we have visibility on the tariffs. So the tariff, if you didn't know what was going to happen in February, now you know what's going on with the tariffs. The second is you have to start looking at 2026. We're in the middle of 2025. The stock market always looks 6 to 12 months ahead. So you want to think about 2026 right now. And next year, we have tax cuts. We have a lot of deregulation in the pipeline. And we have more Fed cuts in 2026. Like the Fed's not cutting now, but they're going to cut next year. And companies are benefiting from freer trade. These tariff deals are allowing U.S. companies to have better access to other markets. That's big upside. So if you ask me, I think there's a lot of earnings upside for next year. And a second thing to keep in mind is that companies are battle tested now. This is what you have to remember. We're living through history because COVID happened in 2020. And I've been in markets for 35 years. COVID was the most improbable thing. You had to go back to 1918 to find a precedent, and there wasn't anybody alive. No portfolio manager was managing money in 1918 unless they were a time traveler. But companies survived that. Then companies survived the bullwhip supply chain effect in 2021. They didn't go bankrupt. They didn't go bankrupt in 2020. They didn't go bankrupt in 2021. Then we had the biggest inflation surge since the 70s. No company went bankrupt. And then Fed did the fastest rate cycle in history. Earnings grew. I mean, think about that. Like, we've taken the S&P through 4 huge tests at them, and they kept growing earnings. By the way, did you look at European cyclical earnings during that time? They've been terrible. Asian EM stock earnings were horrible during this 4 years. The only region that was growing earnings during that period of time was the US. And now we just threw the tariff gauntlet at them. And if you look through first quarter earnings, 79% of companies beat by an average of 8%. I mean, it's been a pretty good quarter. So I think companies survived the latest black swan, and yet investors are shockingly cautious still. And like, for instance, if I could see a show of hands, before I spoke, could you raise your hands if you are cautious or bearish right now? Okay. And then how many of you are bullish now? All right. You're the smart ones. And I think it's really because I think PEs should be going up. So like, there's people who are telling you, oh, U.S. exceptionalism over, the PE should be contracting. I think the multiple of the market should be increasing from here. And just don't forget, everyone told you there was not a Trump put. There is a White House put on the stock market. And remember, everyone's going to tell you there's no Fed put. There is a Fed put. You have a Fed put and a Trump put, which is why I think there isn't the same downside on stocks that people expect. However, in the near term, market could be overbought. Mark Newton's going to talk about that more tactically later today. I'm just giving you my thoughts about the next 6 to 12 months. And in terms of what we want to own, this is how we would be playing a stronger 2026, okay? You want to buy washed out stocks. This is something Walter Deemer references. It's a stock that's so sold out that there's no one left to sell it. And among that is the Mag 7 and Bitcoin. I think they both peaked early. They both bottomed before the S&P bottomed. And a lot of the Mag 7, as you know, got really washed out. Look at Tesla, for instance. We like small caps because they're benefiting from deregulation and an easing Fed, which is happening next year. And of course, that means you'll have a better merger environment next year. We like industrials because of all the onshoring and potentially expensing, 100% tax expensing of your CapEx. And we like the financials because, if the US is not in a recession, then financials lead us out. And by the way, I think a new bull market did start on April 7th because we had a 20% drawdown. So the bull market post-COVID ended with 2022, and then there was a bear market, and then the 2022 bull market started in October. It ended February 18th, and we're in a new bull market. So just think of it as sentiment has completely reset. If you're receiving our research, we talk about the AAII sentiment has gotten so bearish, it's associated with the bear market. So we've already reset expectations to what you expect to see at the start of a bull market. And we have a list of washed out stocks if you're trying to do this individual names, like Coinbase. Well, see, these stocks have already moved, but we had identified these a few weeks ago. Coinbase, Tesla, Robinhood, super micro, MicroStrategy. But you know what? Each one of these is moving on their own time. So I don't think it's too late to buy any of these. And these are the SMID cap washed out stocks as well. And they have a similar profile that we've been identifying. But as I mentioned, and I'll just wrap up in a couple minutes so I can take some questions. We also have, we created an asset management business last year called Fundstrat Capital, and we launched an ETF called Granny, for Granny Shots, ticker GRNY. And Granny just celebrated its 6-month birthday this past week, and we surpassed $1 billion of assets under management. So, yeah, thank you. That's and Granny, I think what's interesting or good news is that in the black swan year that it's been, Granny Shots is outperforming the S&P by 360 basis points. So Granny is actually positive year to date by more than 5%. But Granny Shots, if you're not familiar, it's named after Rick Barry and his unconventional way of throwing free throws. He makes 90% of his shots, whereas most people try to shoot overhanded. And the way we do Granny Shots is we identify the most important themes behind the market. So you've seen in my past presentations me talk about millennials or automation or cybersecurity or easing financial conditions. Then we identify the most important stocks quantitatively correlated with those themes. And we have tactical themes like style, tilt, seasonality, and PMIs. But to be a Granny Shot in our ETF, you have to appear in more than one theme. So a stock has to have two drivers of its long-term value generation. And so the more times it appears in a theme, the stronger the Granny Shot is. So Google, Meta, Apple, Caterpillar, Garmin, NVIDIA, and Palantir are examples of the strongest Granny Shots we have. And we just added in our rebalance Robinhood, Monster Beverage, GE, KLA Tencor, and FICO. And then maybe on a final note, before I take questions, because I think I only have 5 minutes for questions. This black swan of 2025 is a reminder, try not to time the market with most of your money, okay? And here's the math I want to give you. Since 1928, the S&P returned 8% a year. But if you missed the 10 best days of every year since 1928, your return is negative 13%. Those 10 best days are 2,000 basis points a year. So 20 percentage points of the gains in any year come from 10 days. And then since 2015, okay, for the last 10 years, S&P returned 12% a year. But if you didn't own the stock market in the 10 best days, and like this year we had most of those 10 best days happened since April 7th, your return's minus 10% a year. You literally lose money if you try to time the market. Unless you're a really good market timer like Mark Newton. So that's 2,200 basis points a year. And I'll just give you an example. Like in 2023, the S&P was up 24%. But if you missed the 10 best days, you were only up 4%. And last year, the market was up 23%. But if you missed the 10 best days, you only were up 4%. So, don't time the market. And with that, I'll just see if there's any questions.
Tom, thanks for coming to the Money Show. Quick question. The grannies are for the large cap. What about SMID cap? Are you going to have an ETF coming out soon on that?
Well, thank you for the question. We actually sorry, I got to explain a little bit. The Granny Shots was originally a research list published for our clients, and since 2019. And for the 6 years through 2024, it had outperformed the S&P every year for those 6 years. That's why we launched the Granny Shots ETF. So it's no longer in the research business, it's in the asset management business. However, we've created the SMID Granny Shots research list. And that actually has been available to our subscribers, and it's actually doing better than Granny Shots. And Mark and I do a monthly webinar. Next week, Thursday, is our next one, where we go through the SMID granny shots, the best ideas and the worst within that list. But we can't talk about future products within Fundstrat Capital, but I would say that there's a lot of people, including our clients, that want us to do the SMID granny as an ETF, just because it's very tax efficient. You know, with granny shots, instead of them having to rebalance every quarter with the research list, now it's all in one wrapper and it's tax efficient, because ETFs don't generate capital gains with all the rebalances.
So I started following the markets only in 2020, and it strikes me that we had a big bear in 2020, big bear in 2022, and I believe, and you seem to agree, that we just had a bear market. So basically, we're in a bear market every 2 years. Is that the new normal, and how to manage that compared to all those who used to have 10, 20 years bear bull cycles?
Yeah, it's a good question. There is something that I noticed. The bull and bear busts, I noticed a lot in Bitcoin because, we as a firm, we also have been writing a lot of research on Bitcoin, and we've recommended it for 9 years now. And the idea of 2-year bull bear market cycles is a crypto thing, but somehow it's become part of the stock market too. I wonder if it has to do with instant liquidity, because I noticed that our institutional clients, they basically go to 100% cash just as quickly as an investor does now. And but as you know, that unless we're going to have a bigger drawdown than 20%, it's a mistake to go to 100% cash. Even if you think we're going to go down 20, because unless you think we're going to go down 50, then you should go to cash. But a 20% decline is pretty easy to recover from, and that's what happened this year.
Tom, congratulations on the Granny ETF. I was just wondering, how do you decide on the allocation to each asset in the portfolio? How do you decide on the weighting?
We actually equal weight every stock in Granny shots, and we equal weight it and rebalance every quarter. And yet it's still been outperforming. The thing to keep in mind is we actually ran a simulation if we didn't reweight it, because NVIDIA has been a Granny Shots stock list since 2019 when it was like $20. Believe it or not, the performance differential is negligible. It has not made a difference that we've rebalanced to equal weight every quarter. It's like cumulatively 200 basis points. I mean, I was pretty shocked, but it didn't make a difference.
Hi, Tom. Big fan of you. So you've been covering BTC for a quite long time, and I love your narrative. I have this question around BTC cycles. So they've been around halvings, but since the reward is diminishing itself, what about the narrative? There is different kind of capital right now in BTC, and what if those cycles will not? What if those cycles will transform, and what if we'll see completely different market structure?
So the question's about Bitcoin, and if you're not that familiar with it, there's a couple things. One, just as a firm, we've recommended a 2% allocation to Bitcoin at a minimum, but we've recently been advising closer to 5%. And if you're younger, 10% I think would be fine. And Bitcoin has 3 or 4 things it really follows, okay? It follows network effects. So the number of wallets and the activity per wallet still explains 87% of the price change in Bitcoin. Bitcoin still follows global liquidity, which I am shocked at, but there's a 10-week lead time. So if central banks ease, Bitcoin follows by 10 weeks. And the third is the halving, which is when the block reward gets cut in half. I don't think it's following the halving cycle as closely yet, but we'll find out. Actually, the next 3 months will determine if it's true or not. But look, if Bitcoin at 100,000, it's still early days. Keep in mind the following. 95% of all, and I heard this stat yesterday from Bitwise, and it's very accurate. 95% of all the Bitcoin has been mined. There's only 5% left in the supply. That's very scarce. Like gold is still unlimited in its supply. Yet the US government wants to buy 5%. Institutions this year bought more than 5% of Bitcoin, and they probably want to buy 15%. MicroStrategy wants to buy 5% of Bitcoin. Another sovereign government probably will buy 5%. If you total this up, there's 40% non-retail demand for Bitcoin in the next 2 years for 5% that's available to purchase. That's why I think Bitcoin probably will have the same network value as gold, which would put it at around 1 to 1.5 million per Bitcoin. Okay, thanks.